Okay. Good evening, friends. On behalf of the Institute of Chartered Accountants and especially on behalf of the Direct Tax Committee, I would like to welcome you all on this very beautiful evening today. Friends, we have a very today on this evening, that is the new exemption law as far as the charitable institutions are concerned, and also on the taxations of charitable institutions. Friends, we all know, we have studied what is charitable institutions and what is a charitable, so I don't want to talk on that. But yes, it is always a matter of concern. Therefore, I thank the Direct Tax Committee to take the initiative for all of us to have this virtual webinar today on the very interesting topic, which is not been so well accepted by our fraternity. But yes, this field is another field which is growing on to a very large extent, and therefore we should take interest, and therefore with this intention, the Direct Tax Committee has taken up this topic today. Friends, on this occasion, I would like to first welcome our chairman of Direct Tax Committee, who is also our faculty for the evening, C.H. Chandrasekhar Chitre, sir. Good evening, sir, to you.
Namaste. Good evening.
Namaste. I also welcome CA Dr. Raj Chawla, sir, who is also Vice Chairman of the Direct Tax Committee. And therefore, before we start this session, I would like to request CA Dr. Raj Chawla, sir, to give his opening remarks on this particular occasion. Over to you, sir. Sir, you are mute, sir.
Thank you, CA Chandrakant Kaleji, and good evening to all. At the outset, I, on behalf of the Institute of Chartered Accountant of India, extend a warm welcome to CA CV Chitale sir, our Chairman of Direct Tax Committee, in this webinar on Charitable Institution, New Law on Exemption and Taxation. Direct Tax Committee of ICI, as partner in nation building, has always been working towards facilitating the objective of the government, and at the same time plays a pivotal role in strengthening the relationship between the taxpayer and the department by bringing to the notice of the department genuine hardship being faced by the assessees under the income tax law and to ensure timely redressal of the same, and by advising and helping stakeholder for proper and timely compliances. Our today topic of discussion is on the recent development in charitable institution taxation regime, that is latest laws on its exemption and taxation. Charitable organization enjoys exemption from tax net as they play a vital role in enriching our cultural heritage and catering to the educational, medical, socio-economical and religious need of the people. Significant amendments were proposed in the previous budget, and now the Finance Act 2022 has made further amendment to the rationalizing the provisions related to the charitable organization to bring in uniformity, clarity on taxation in the specified circumstances and ensure their effective monitoring and implementation. Presently, charitable institutions can claim exemption in respect of their income tax section 1023C and 12AA and 12AB of Income Tax Act 1961. The Finance Act 2022 has made amendments under both regimes. Some amendments are made to bring consistency in the provisions of two regimes, while some amendments are made to clarify existing provisions. By aligning the provisions, the amendment intended to monitor the charitable organization in fulfilling the objective for which they were formed and ensure that there is use of the tax concession enjoyed by them. The charitable organization will be required to put in system and process to ensure greater compliance to continue avail tax exemptions. With the advent of the faceless era of tax assessment information, sustaining account of income and claim for deduction is being collected from resources. New law has come into force from 1st of April 2022, assessment year 22-23, that requires charitable and public religious institutions to provide information relating to donation received that qualify for deduction under Section 80G of the Act. Deductions to donor will be available on the basis of such information furnished. Section 80G provides for deduction for eligible donation made to charitable and public religious trust from gross total income. Donors claiming such deductions will be able to substantiate the same. Therefore, instead of seeking information from each donor, the responsibility has been casted on the institutions receiving such donations. Donee has to furnish detail of donation received under Section 80G in Form 10BD. Form 10BD is to be furnished by 31st of May following the financial year of the reporting. That is for financial year 21-22. As of now, it is 31st May 22, means thereby tomorrow. It is expected to be extended as concerned assessee are facing genuine difficulties in furnishing Form 10BD, which is the first time complies. Post filing a statement of donation, donee is required to download and issue certificate of donation in Form 10BE of the donor. And I am also happy to announce that our Chairman Direct Tax Committee, Chitale sir, has recently prepared a guidance note on this section, and that is easily available on our website of Direct Tax Committee, or you can contact us. We will provide you the soft copy of that. So you will be helped to filling this statement. I hope that the participant would be benefited a lot from the today's interaction and discussion, and also would provide an ease in implementing and making requisite compliance of the topics of deliberated upon. So thank you very much.
Thank you, sir. Thank you for your opening remarks and giving some insights on the charitable institutions. Friends, before we start, I would like to formally introduce our today's speaker, but though he does not require any introduction because he is a well-known to all of us, though he is a CCM and he is running the second term today with our institute, and he has not only headed the direct tax committee in a previous council, but in this council also he is heading the same direct tax committee as a chairman. He is also vice chairman of the banking, financial services and insurance. He is also member of multidisciplinary firms of chartered accountants committee and former vice chairman of the committee on public and government financial management. He has been also serving to various committees such as International Taxation Committee, Indirect Tax Committee, Valuation Standard Boards, Accounting Standard Boards, Auditing and Assurance Standard Boards, Internal Audit Standard Boards, and so on and so forth. He has been a member of the Pune branch of Institute of Chartered Accountants as a managing committee member, and was also chairman of the Pune branch in the year 1988-89. He has been vice president of the Pune Chartered Accountants Society in the year 1997 to 1999. He was also a chairman of Direct Tax Committee of the Maharashtra Chamber of Commerce for Industry Association, and he has been for more than a decade. He was also treasurer in the same MCCI or CIA also. He was also nominated on the Cost Accounting Standards Board and Cost Auditing and Assurance Standards Board of the Institute of Cost Accountants of India. He has also nominated by the Institute of Chartered Accountants to prepare representations on Direct Tax Code 2010. He has written so various books and for our institutes, and has also written several articles in various newspapers, periodicals, journals released by Taxman, Sakal, Maharashtra Times, which are been running locally throughout the Maharashtra. He was also awarded the first prize of R.T. Doshi Foundation for the best article written in the Pune Chartered Accountants Society's newsletters. He has been a lecturer in Garware College of Commerce, Pune, And as I said, he has been delivering various lectures in various seminars, forums, not only conducted by our institute, but also conducted by various associations. So with this brief and short introduction, though it is very long, but I cut the thing short for you because we have to give more time to our faculty rather than spending time on other issues. So with this, I would like to hand over this session in the hands of our own CS Chandrasekhar Chitale sir. Over to you, sir.
Well, thank you for the introduction. Friends, as far as this subject of charity is concerned, it is not new to our country. As far as Indian mythology is concerned, Indian history is concerned, we find several examples of not only kings but also very ordinary persons from rank and file really doing charity for the benefit of mankind. So, as far as Income Tax Act is concerned, Income Tax Act also has given a kind treatment to the charitable institutions, and that the charitable institutions which are doing great work for the benefit of the society, they are spared from taxation. But then, as you know, when anything is spared from taxation, at times it is susceptible to misuse. It is therefore necessary that it is regulated in a particular manner. Therefore, while conferring this benefit of tax exemption for charitable institutions and religious institutions, certain requirements are prescribed, and those requirements are becoming stringent year by year. Particularly, as stated by our Vice Chairman Raj Chawlaji, the Finance Act 2021 and Finance Act 2022 have made these provisions further stringent. So it requires more than little attention to all those changes and how the field of this exemption and taxation of charitable institutions is operating today. So let me share the PPT, and with that we can then proceed. So office, can you share PPT? Yeah, next. Charity. So, as far as charity is concerned, you and me understand what is charity. It is benefiting the poor, providing redressal to the needy, etc. Of course, when it comes to income tax law, we have to formally understand what is charity. And blissfully, the law has given some meaning to the charitable purpose. So, if the institution exists for charitable purpose, then it will be entitled for the purpose of tax exemption. This definition is given in an inclusive manner. So, if something is there which you and me believe that it is of a charitable nature, but does not find place in this definition, that will also be the meaning of charity. The onus of proving that that act is of charity will be more. अरे मत आगे लो, मैं जब तक नहीं बताता हूँ. So that also will be considered as the act of charity. But now there are certain aspects which are expressly defined to be a charity. And let us have a focus on those express aspects which are defined to be a charitable purpose. So it includes activities for one, relief of poor, secondly, for providing education to the people, thirdly, providing yoga training, experience, etc., then medical relief, then preservation of environment, including watersheds, forests, wildlife, etc., and preservation of monuments or places or objects of artistic or historic interest. These are the specific objects which are considered as charitable purposes. And then there is a residuary object, that advancement of any other object of general public utility. So these 7 aspects are certainly considered as charitable purpose as per definition given in clause 15 of section 2. Only in this case, as far as the last object, residual object, the advancement of any other object of general public utility is concerned, further conditions have been prescribed. Next. So this earlier one. So it is stated that if there is advancement of any other object of general public utility, the object of a charitable institution, then in that case, certain conditions have to be fulfilled. Then only that activity will qualify as a charitable purpose. Take example of running a chamber of commerce. In this case, it is not covered in earlier 6 objectives, so that can be considered as any other object of general public utility, where it says that it will not be considered as a charitable purpose if it involves carrying on of any activity in the nature of trade, commerce, or business, or any activity of rendering services in relation to trade, commerce, or business for cess, fee, or any consideration, irrespective of the nature or use of application, relation of the income from such activity. So if any charitable institution is pursuing this advancement of any other object of general public utility, and it is carrying on any trade, commerce, business, etc., and charging fees, charging compensation, in that case, it will not be considered as a charitable purpose. Next. And to this, there are 2 exceptions. So, these 2 exceptions are such activities undertaken in the course of actual carrying on of such advancement of any other object of general public utility, and the aggregate receipts from such activity or activities during the previous year do not exceed 20% of total receipts. So friends, what we understand from this complex definition is, if any institution is pursuing any other object of general public utility, then in that case, primarily it will be considered as a charitable purpose. However, if that particular organization is carrying out any trade, commerce, or any activity in trade, commerce, then it will not be considered as a charitable purpose or pursuing charitable purpose. However, again, if that pursuing of trade, commerce, etc., or business is for the purpose of furtherance of this very object of advancement of any other object of general public utility, and total receipts from this activity are not exceeding 20% of total receipts, then again it will qualify for charitable purpose. To give an example, supposing a chamber of commerce carries out some trade exhibition. In that case, carrying out trade exhibition is for the purpose of advancement of their object of chamber of commerce, because chamber of commerce exists for the purpose of benefit of this trade, commerce, industry, agriculture, etc. So in order to give benefit to those members, they organize a trade fair. In that case, this trade fair will qualify first condition that this trade fair is necessary for advancement of their own object. But secondly, if the aggregate receipts are up to 20% of total receipts, then only it will be considered as charitable purpose. So if the total receipts of the institution is say 10 crore rupees, then in that case, if exhibition receipts are more than 1 crore, then it has not fulfilled this condition, and both the conditions are mandatory. But if it is less than 1 crore, then it will be considered as having fulfilled the objective. So that way, one will have to examine wherever the object is object of furtherance of any other object of general public utility, what activities they are doing, whether those activities partake character of carrying on trade, commerce, or business, and if yes, whether these 2 conditions are satisfied, then only it will be considered as charitable purpose. So when we are advising any such institution, we can ask them to take precaution. Say for example, if the trade fair is to be organized by a chamber of commerce, and if the receipts are going to be heavy, then it would be better that the chamber of commerce coordinates with some PR agency, and that PR agency organizes everything. They charge the fees, and only out of whatever surplus they generate, or maybe a fixed fee is paid to the chamber of commerce. In that case, the receipts would be within the elbow room of 20%. So that type of advice we will be able to provide if we are aware of this particular definition. Then loosely we call charitable trust. During the discussion also I will be calling charitable trust, but please try to understand it is not confined to the charitable trust. These exemption provisions are applicable to the entire spectrum of organizations which carry out charitable activities. Who are they? One is obviously the trust, which is registered under state laws. Secondly, it may be a company registered under Section 8 of the Companies Act 2013, or maybe Farmer Companies Act 1956, which has object of carrying out general public utility and not for the purpose of profit. It may be in the form of society, or it may be in the form of somebody's will or some other document. Take example that if there is drought in some village, then villagers come together and they pray God, and they say that okay, God or whatever is the religious person or entity, and they said that if it rains, then we will construct a temple, we will worship you, whatever. In that case, supposing if rains in a better fashion in that year, maybe the whole village will contribute and they will erect some temple. So this temple belongs to the entire village, so there may not be any formal document. Still, it will be a common property held for the purpose of religious or charitable purposes. So such type of institutions are also covered. Under a will, a person may say, a wealthy person, he may say that okay, out of my assets, maybe 10 crore rupees should be used for the purpose of giving education, etc. So those 10 crore rupees would be earmarked out of his estate and they will be used for such charitable objects. So all such type of organizations are charitable institutions and they are governed by these exemption provisions. Next. Next. Now when we, earlier one. Now when we talk of charitable institutions which carry exemption, it is not solely the charitable objects. Besides charitable objects, institutions who are exempt under the tax law, under section 11, 12, 13, there are also certain religious institutions which also enjoy exemption benefit. But those religious institutions, for the purpose of claiming exemption under section 11, must be public religious trust and not private religious trust. So if it is a public religious trust, then benefit of exemption would be available to such a trust. Next. Next, Supreme Court had occasion to consider what is public religious purpose, and that in the decision of reported in AIR 1963 SC 1638, they said the answer to this question is, are the members of the public entitled to take part in offering service, in taking darshan in the temple? Are the members of the public entitled to take part in the festivals, ceremonies arranged in the temple? Are their offerings accepted as a matter of right? Will establish the character as a temple. Therefore, participation of member of public is the important aspect to be borne in mind for the purpose of treating it as a religious trust. There may be any private temple, private mosque, or a private gurudwara, private church, where only members of a particular family are entitled to take, or maybe members of a particular caste are entitled to do the religious activities. So these would be private religious trusts. The tax exemption will not accrue to private religious trusts. It is available only to public religious trusts. Next. Next. Now, having understood what is charity, having understood that this benefit is available to trust, company, society, or any other entity which is pursuing this charitable or public religious activities, we have to consider how the provisions of exemption operate. Now, this particular aspect has been discussed in canvas of three topics. One is donations, next is exemption, and third is registration. The donation per se may not be relevant for the purpose of taxation, but since new law has come up, and as Vice Chairman said that okay, tomorrow is the last date for the purpose of furnishing the forms which are required to be furnished and under the new law. Briefly, we will consider this law relating to donations, and then we will move ahead to exemption and registration. Next. Next. As you are aware, under section 80G, there are certain charitable institutions which qualify for deductions. There are certain institutions which are named like Prime Minister's Earthquake Relief Fund, Chief Minister's Funds, etc. So these trusts, maybe in some cases they qualify for 100% deduction, in some cases they qualify for 50% deductions. So all those deductions are available. And in this case, there is one residuary category. And that residuary category is the trust which are registered under Section 12AB, which enjoy the benefits of Section 11, 12, 13, etc. So, if any donation is paid to such charitable institution, 50% of the aggregate sum specified are eligible for deduction. Of course, there are other conditions also, that these qualifying donations should not exceed 10% of gross total income, etc. Donations exceeding 2,500 should be otherwise than by cash. Donations which are given in kind do not qualify for deduction. So there are number of conditions. However, in case of such conditions, if the trust is going to accept the donations and they want to confer benefit of Section 80G, then a new procedure for the purpose of registration of the charitable trust was brought into being from 1st April 2021. So those trusts not only have to register themselves under 12AB, but they also have to register themselves under Section 80G. Now, when we talk of charitable institutions, there are three types of charitable institutions. One are enjoying exemption under Section 1023C, which are hospitals, universities, educational institutions, etc. There are charitable institutions which enjoy exemption under Section 11, 12, 13. And there are certain research organizations which enjoy deduction under Section 35. So if donations are paid to any of these organizations, they qualify for deduction under various sections. For all those, new law has been made about reporting of donations, but we will be restricting ourselves to these particular deductions which are under Section 80G. Hello. So we will be confining ourselves relating to today's topic, that is trust enjoying exemption under Section 11, 12, 13. So 80G applies to donation to the institutions under Section 85A only if it is established for a charitable purpose in India and it fulfills certain conditions. Next. So Section 80G5 has put certain more conditions for the purpose of enabling the donors to get deduction, and the responsibility has been cast on the trust receiving the donation. So it says that the institution prepares in a prescribed form a statement of all donations which are received during the year, and they are submitted to the income tax authority. Of course, these are to be submitted electronically. The prescribed form is Form 10BD and the due date is 31st of May. So what this has commenced from 1st April 2021. So the first financial year has concluded on 31st March 2022. So whatever donations received from 1st April 2021 to 31st March 2022, they will be reported by respective institution in Form 10BD to the Income Tax Department, and the due date is 31st May. The mode of communication is electronic, so you are required to furnish the statement electronically. Now one more prescription has been made, that if you have to correct the statement or rectify any mistake to add, delete or update the information, you are allowed to do so. So unlike TDS, here express provision for correction statement for rectification has been made. So one has to take note of it. Next. Once when this statement in Form 10BD is uploaded, the system will generate Form 10BE, and this Form 10BE will be issued to the donors, so that based on this particular form, they will be able to claim the donation deduction under Section 80G. If this form is not available, then the deduction under Section 80G will not be possible. So as far as this, not only you have to upload the Form 10BD, but also you have to download the Form 10BE and issue it to the donor. So both these conditions are required to be satisfied by the charitable institution, and for this also the due date is 31st May. Now failure to comply, if you are not able to furnish Form 10BD, not issue Form 10BE, then there are serious consequences, because as far as section 234G is concerned, for each day of delay, 200 rupees per day is the additional fee which is required to be paid. Of course, there is a maximum cap of the underlying amount of donations. And also under section 271K, penalty from rupees ranging from rupees 10,000 to rupees 1 lakh attracts. So it is onerous responsibility which is given to the charitable institutions. If they fail to comply, these disastrous consequences follow, and moreover, the donors will be deprived of the benefit of deduction. Therefore, goodwill of that particular charitable institution will erode, and they will find it difficult to solicit donations thereafter. Next. Now, there are certain issues which are faced. So those issues are there. Before the issue, we'll consider that 10BD form is in two parts, Part A and Part B. Part A is pre-filled when you open it for a particular institution, and Part B is required to be filled in. And Excel-based utility is available. So if you put all information in Excel file, then it can be easily uploaded on the system. Next. While doing so, there are certain issues which have been faced by the stakeholders and which we have escalated to the CBDT. One is the question asked is whether there is a threshold limit for the purpose of reporting donation, because various temples, other organizations receive thousands of donations ranging from 51 rupees, 501 rupees, 1000 rupees to crore rupees. Unfortunately, the law is silent on any limit. So even if you receive donation of 51 rupees, 25 rupees or any other amount, it is reportable. Particulars not available, incomplete. It is possible that while you receive donation, maybe you have not taken down all the particulars which are required to be included in Form 10BD. Of course, one can also say Form 10BD was not available at that time. So maybe permanent account number may not be available, full name may not be available, full address may not be available. So if particulars are incomplete, not available, what is to be done? Here one can consider practically that maybe you have received, let us assume, 200 donations in a year, and only about 30 donations you have complete information. Balance 170 complete information is not available. In that case, what policy a institution or trust should adopt? So there, practically, if you consider, if you furnish the statement in Form 10BD on or before 31st of May, then the statement has been submitted on or before the due date. So the clock of 200 rupees per day will stop clicking. Also, the penalty will not attract because you have furnished, there is no failure to furnishing. Only default is the information is not full. So whenever this information keeps on coming, maybe you go on uploading that information or updating that information in the form, so that gradually you will be able to provide information of all the 200 persons. Of course, if all persons do not give information, maybe that will be a limitation for the charitable trust to provide that information. In this case, after uploading for 30 persons, maybe trust should also make efforts, write letters, etc., or make public notice that these are the 170 persons or persons for whom total particulars are not available. So they may contact the trust or the trustee. Some information should be given. Maybe you can communicate them on WhatsApp, you can communicate them by SMS, by letters, by whatever means you want. If the trust is really large, maybe on radio, television also they can make an announcement. So that if tomorrow the allegation comes from the department that you have not given full information, at least the trust will be able to defend its own case. Then donations in offering box. At various places of worship, offering box are placed where people put money, and that those money funds also may be running to lakhs, crores, etc. In respect of such donation, whether the information is required to be furnished, the answer is yes, there is no exception. However, in case of donation, when the details are in offering box, since the details are not available and it is obvious reasons, I don't see any problem if this information is not furnished. In case of donations received in foreign currency, in kind, you will have to translate it on some basis and report it, because the form also asks this information donation received in foreign currency or in kind. Of course, donations received in kind do not qualify for deduction. It is also possible that any institution might have made appeal to pay donations in local media, in virtual media, WhatsApp group, whatever, and maybe directly by transfer of funds from banking channels. In their bank account, the funds are credited, but you don't know the details of the donors. In that case, there will be difficulty in finding out. Maybe similar efforts of finding out the donors, their particulars, should be undertaken by the charitable institutions. Donations received from other charitable institutions, whether this is required, because they won't be claiming ATG, but the answer is yes, that is also required to be reported. Next. Then record, in some cases it was reported record is lost in flood. In that case, it will be a handicap, but then such trust will have to inform the income tax department that our record is lost in flood or whatever, cyclone, and therefore we are not able to comply with it. Now, in earlier case and this case, wherever donations, the particulars of donations are not available, then what is the consequence? There may be one consequence that those donations being treated as anonymous donations under section 115 BBC, and they are separately taxed at the rate of 30%, and they will not enjoy any exemption. So that possibility also exists. Therefore, wherever incomplete information is available, information is not available, one should make efforts to get the information, that if the charge of those being treated as anonymous donation is made against the trust, they would be in a better position to respond. What view is to be taken will ultimately depend upon the assessing officer and the particulars available with the assessee. However, now itself they should make all the efforts to ensure that they get all this information from the donors. To this anonymous donation, as you are aware, that there is one exception, and that exception is the religious institutions. If religious institutions receive such donation in their offering box, etc., in that case, they are not treated as anonymous donation. So, besides public religious trust, if any charitable trust receives donation for which particulars of donor are not available, there is a risk of those donations being taxed under section 115 BBC at the rate of 30% without any deduction. Now, how many times Form 10BD can be revised? The answer is there is no limit as such. Whenever you find information, rather than waiting for getting all the information, maybe you can decide at the weekly interval or fortnightly interval, you can correct the Form BD which has been uploaded, so that the Form 10B can be generated and your trust donors would be able to get the deduction. Only one thing one has to remember, that earlier I said in case of incomplete information, you please furnish the Form 10BD. So there is distinction between the revised return and correction in this particular Form 10BD. When we talk of revised return, the words used are if any error is made and which is subsequently noticed, then the return can be revised. But here it is not revision, it is correction. And correction for mistake, there is difference between error and mistake. Mistake can be deliberately, may happen deliberately. So if you have limited particulars, maybe in order to comply with the timeline, you furnished it with the available data so that those donors do not suffer, and then you can go on revising, which technically for this section is called correcting. Therefore, I believe that since the specific provision has been made for correction, we need not wait till getting information of all the donors. With available information, we should meet the timeline of 31st of May. Let us hope that it will be extended to 30th of June, because there are a number of charitable trusts who have represented, and we have also apprised the board of this particular limitations. Next. Now let us talk about exemption and taxation of charitable institutions. Next. When we discuss about this scheme of exemption, we will be discussing under these 6 captions. One is, what is the broad scheme of exemption? What are conditions to avail the exemption under section 11, 12, 13? There are certain situations under which the exemption can be withdrawn. What are those situations? because unless we know those situations, we will not realize that the exemption is likely to be withdrawn. Then what is income of the institution? What is application of income? And in what circumstances a trust can accumulate the income and spend it in a subsequent period. So under these six captions, we will consider the exemption provisions in respect of charitable institutions. Next. Exemption scheme. Next. So exemption scheme is provided in section 11. What broadly section 11 provides is whatever is the income of a charitable institution, you can maximum accumulate up to 15%. So you can hold in balance 15%. Maximum, you can hold less than that also, but you have to spend the balance amount. So minimum amount to be applied would be 85%. So if a trust has collected 20 lakh rupees as income during the year, then maximum it can retain is 15% of 20 lakh. So 3 lakh rupees it can keep in balance, but minimum 17 lakh rupees the trust has to spend. It can be 17 lakh, it can be 17 lakh 50,000, it can be 18 lakhs. You can spend more, but you cannot spend less. If you spend less, say you spend, instead of 17 lakhs, if you spend 15 lakhs, then in that case it is possible that the exemption can be withdrawn. Of course, this is a broad rule of expenditure 85% and maximum accumulation 15%. Besides this, there are certain conditions which are required to be complied with, like registration, accounts, audit, etc., which we will be discussing. And there are certain negative provisions which result into withdrawal of exemption. They are required to be avoided. Say, for example, funds of the institutions are invested otherwise than in prescribed mode, or benefit is given to the trustee. So these are some of the trigger points where it is likely that the exemption available to the charitable institution can be withdrawn. So charitable institutions have to avoid such trigger points. Next. So let us consider that the donation received is 7 lakh rupees, membership is 8 lakh rupees, and rent is 5 lakh rupees. So what is the total income? So when we are on income, we will say that donation received is also income, because that is expressly provided as income under section 2, subsection clause 24. Whether you call it membership fees or you call it donate, otherwise whatever amounts are received from members, they are also considered as a donation, as income of the charitable institution. And supposing you have some property and that property is given on rent, in that case if you receive the rent, then that will be income. So 7 plus 8 plus 5, that is total 20 lakh rupee would be the income of a charitable institution. Here we have to calculate the income in a commercial sense and not by following provisions of section 14 onwards, chapter 4. So in case of rent, one cannot consider 30% standard deduction available for repairs, so it will be considered as 5 lakhs and not 3,50,000. Now the question is, what can be the maximum accumulation? So we have seen 15% is 2 lakh rupees. What is the maximum amount of application? So maximum amount of application is not 17 lakhs, it can be 20 lakhs. Of course, if you have earlier balances available, you can even spend more than 20 lakh rupees. So there is no limit on maximum application by any charitable institution. And if a charitable institution has purchased ambulance or say construction of premises for say 20 lakh rupees, it is typed as 2 crore, but let us assume it is 20 lakh rupees. In that case, whether it is considered as application. So let us try to understand, when we are talking of charitable institution, it is a separate code in itself. Provisions of chapter 4 do not apply, where we are used to have depreciation in case of capital expenditure, revenue expenditure is allowed, etc., etc. Here it is application of income for the objects of the trust, and those objects should be charitable or public religious. Here ambulance you are providing for medical relief. Therefore, even if you purchase ambulance, it may be a capital outflow. Still, from this 20 lakh rupees, the entire purchase price of ambulance will be considered as application. Similarly, you are undertaking construction. The total construction value is 50 lakh rupees. In this year, supposing you spend 20 lakh rupees, that will be considered as application. It is not necessary that premises construction should be complete in that year. Even if it is WIP, doesn't matter. Next. Now, conditions for exemption. So this is the basic theme of 85% spending, maximum 15% accumulation. If you do that, you are out of tax net. But what are other conditions which are applicable? So let us see conditions for exemption. And next, these are given in section, various sections. So those sections we will consider. Next. So if you look at section 12A, 12A lists some certain conditions which must be followed by a charitable institution for the purpose of enjoying exemption. These must be followed by public religious institution in order to enjoy exemption. There are 5 conditions principally we have to look at. One is registration, which is applicable under section 12A1 AC. Then maintenance of books of account. Then audit of accounts. Your books of account must be audited. Then you must furnish return of income under section 139(4)A, and you have to apply those the amount of income for the purpose of charitable or public religious objects. Let us consider these in detail. Next. So the first condition is registration. As you are aware that the law relating to this registration was thoroughly changed earlier year. Again, it was put on a hold on tail because of this corona pandemic. But again, now it has been brought into being from 1st April 2021. So we have seen that all charitable institutions existing in the country enjoying the exemption were told that once again you apply for registration and we will grant you registration. If you are already registered in the earlier regime, then without any inquiry you will be given registration. If you are not so registered, applying for the first time for registration, immediately provisional registration will be given, and after giving provisional registration, within 6 months of commencement of activity or the period of provisional registration 3 years, you must apply for permanent registration. So this law we have already we are known, and all the charitable institutions must have followed it, because if you follow this rule of registration, then only you are entitled for exemption. So section 12A1 AC states that each charitable trust must apply for registration. This institution must be registered under section 12AB. So the entire law relating to registration of charitable institutions is contained in 12AB. Under section 12AB, the registration is not permanent or life. The registration has a life of 5 years. So in each case, you will get registration for 5 years, and at the end of 5 years, maybe before 6 months of closing your registration period, you have to apply for renewal of the registration. Then only this registration will continue. At that time, the assessing officer will examine activities of the charitable institution, and in this way, once in a 5 year, there will be detailed scrutiny. So in 5 years, it is not necessary that all the charitable institutions are subjected to scrutiny. Maybe on test check basis, some of them would be scrutinized. And when you are making application for the first time, it is under form 10A, and if you are seeking renewal, it will be under say form 10AB. So these two forms are required to be furnished electronically. So registration is the first condition that a charitable institution will have to satisfy to claim exemption. Next is books of account. As you are aware that charitable institutions are now required to maintain books of account. By Finance Act 2022, this change has been made that total income of the institution without giving effect to section 1112 exceeds the maximum amount not liable to income tax in any previous year, then for that previous year, the charitable institution must maintain books of account. As far as maintenance of those books of account is concerned, the form in which they should be maintained, the manner in which they should be maintained, and the place at which they should be maintained will be prescribed by the board. So in these parameters, you have to maintain books of account. Fortunately, this provision is not expressly applicable for the assessment year 2022, for which now the returns of income will be filed. But for the current financial year 22-23, that is from assessment year 23-24, this maintenance of books of account has become mandatory. Next, audit of accounts. Again, in a similar case where without exemption under section 11-12, if the income chargeable exceeds the maximum threshold, then the accounts of the institution for that year require audit by an accountant, that is a chartered accountant. This audit has to be concluded and report has to be furnished before the specified date under section 44AB. So as you are aware, due date under section 44AB is 1 month prior to the date of furnishing return of income. So where audit is applicable, the due date for furnishing return of income under section 139(1) is 31st of October. So 1 month prior, so by 30th of September, this audit should be concluded. Audit report should be furnished by the chartered accountant, and that audit report should be uploaded on the income tax website by the trust. So these three conditions should be satisfied. The form is form number 10B. Now you will see that in this case, if your income exceeds without this exemption under 11-12 the maximum limit of threshold, then you have to the accounts are audit is already compulsory, and audit cannot be done unless books of account are there. So books of account without being specified as mandatory, they are already mandatory. Only now from the clause 1, they have expressly stated that you must maintain books of account. So the condition of books of account was already there indirectly via audit. So the third conditions for to be complied with is audit. First is registration, secondly maintenance of accounts, and thirdly audit of accounts. Next. Then return of income. It is necessary that each charitable institution must furnish return of income, and this is very serious. If you read section 12A 1BA, in that case a person in receipt of income has to furnish return of income for the previous year in accordance with the provisions of section 139(4)A within the time allowed under that section. Section 139(4)A tells us that for the purpose of considering what is the time allowed, you refer subsection 1, and subsection 1 of section 139 tells us that if the accounts are subject to audit either under this law or under any other law for the time being in force, then in that case the due date would be 31st of October. If the audit is not applicable, then the due date would be 31st of July. So in case of a company, even if supposing annual collection is just 1 lakh rupees, still under Companies Act 2013, the audit is mandatory. Therefore, in that case, the due date will be 31st of October, and all other cases it would be 31st of July. As far as if this condition is not fulfilled, there can be penalty of rupees 5,000, but more serious consequences, that particular charitable institution will not be eligible for any exemption under section 11. So whatever gross receipts which are collected by the charitable institution, those receipts may be exposed to tax, because out of the income of the charitable trust, what you make is application. It is not charge on the income. So supposing donations of 1 crore rupees are received and you have spent 1 crore rupees. So fine, when it comes to computation of income, your income is 1 crore rupees, because spending for charitable objects is not the charge for the purpose of earning income, it is application of income. So those gross donations would expose to tax. And in this case, one more serious note one has to keep in mind is there is no provision for extension. So if you miss the bus, then there will be a fatal consequence of meeting the tax liability on gross amounts received. So today itself we should educate the trusts that wherever you have to you exist, you have to furnish return of income, and be careful about maintaining accounts and furnishing return of income. If not, you will lose the exemption, you will have to pay tax. Next. Next. Yes, this is 139(4)A. Yeah. The next is application of income. 12(2) says that you have to follow 11 and 12 section. You have to maximum accumulation can be 50%. balance can be used for application. More than that also can be used for application. Of course, it may so happen that in a particular year, even if the trust is desirous of spending, for certain reasons it is not possible for the trust to spend, maybe because they have not collected the income, or maybe for the right purpose for which they want to spend. There is a time lag. Maybe you plan to spend on March, but you purchase ambulance in March, but there was shortage of ambulances, and you were told that okay, ambulance can be delivered only in the month of May or June. In that case, you will not be able to apply. So if you are not able to apply, what to do? Will you be exposed to tax? The answer is no. If the charitable institution is not able to apply maximum of 85%, then in that case, certain provisions for accumulation have been made. They will come to the rescue of charitable institution. So those provisions also we will see separately. Next. Now, what happens when we discuss about income, application, etc.? At times, our mind escapes attention about the provisions relating to withdrawal. Therefore, before we consider the provisions relating to income and relating to application, let me first take up withdrawal of exemption. What are those circumstances and what are the likely consequences? So let us see these provisions relating to withdrawal. Next, they are contained in section 13 of the Act. So section 13 tells us there are certain circumstances in which the withdrawal, the exemption, either partly or fully is likely to be withdrawn. Now let us take instance number 1, section 13(1)(a). It says that any part of the income of a trust is spent for private religious purposes which does not inure for the benefit of the public. In this case, that part which is applied for private religious purposes will not qualify for exemption. That amount will expose for taxation. Then B, charitable institution established after commencement of this Act, any income thereof of the institution, if it is established for the benefit of any particular religion, community or caste. So if you have created any institution after this Act and it exists for benefit of a particular caste, particular community, particular religion, in that case also the exemption would be forfeited, and in that case the entire exemption will not be available. Next is about expenditure by charitable institution or application by charitable institution. It says that if any part of income or property inures or during the previous year used or applied directly or indirectly for the benefit of any person referred to in section 13(3). So these are associated enterprises like persons or interested persons. So if you spend any part of income or property you offer for the benefit of such type of interested persons, then also that part of income used for the benefit of interested persons or specified persons will lose the exemption. We will see who are the specified persons subsequently. Before that, whatever amount which are available with the charitable institution, which are accumulated or remaining as a balance, if they are to be invested, they have to be invested in a medium given in section 11(5). So section 11(5) prescribes certain mediums like maybe government securities, bank account, post office savings bank, etc. Those also mediums we will see. So if the amount is invested otherwise than by those prescribed modes, then to the extent of such transgression of the prescription under section 11(5), income will forfeit the exemption. Exemption will not be available to such funds or income. Next. So we have seen that certain persons are called interested persons. So who are those interested persons? This is the list of all persons who are interested. For whose benefit, if the resources of the trust are used, then the exemption would be lost. A, author or founder of the trust or institution. So if it is a company, it may be subscribers to the memorandum. In case of trust, it may be persons creating the trust, etc. Then secondly, a person who has made substantial contribution to the trust or institution, and that substantial contribution is exceeding rupees 50,000. But again, the adjective is up to the end of the relevant previous year. So it is not necessary that those 50,000 rupees should be made at one go or in one financial year. Till the end of a particular financial year, if any person has contributed more than 50,000 rupees, then that particular person will become interested person. Let us assume that one person has decided that annually he will give donation of 10,000 rupees to a particular trust. So maybe for first 5 years he will not be an interested person, because in first year he will contribute 10,000, next year 10,000, so total 20, then total 30, total 40, total 50. And when he gives 10,000 next year, in that year this limit of 50,000 would be breached. So that year onwards, till lifetime of that person, he will be considered as interested person. Then if author or founder is Hindu undivided family, any member of that Hindu undivided family, then if any trustee of the trust or manager by whatever name called of the institution, so it may be board of trustees, it may be managers, it may be board of directors. So all members who are trustees and managers employed as with the trust, they are also considered as interested persons. Next. Any relative of such author, founder, person, member. So we had 3-4 persons earlier. So any relative of such person will be considered as interested party. And any concern in which any of these persons are interested, which we have stated earlier, A, B, C, C, and D. So any of these 5 category of persons, if they are interested in any concern, then that concern, so he is a partner in a partnership firm, or he is a director in a particular company. So all those enterprises can be considered as interested persons. And if any benefit is given to these interested persons by the charitable institution, to the extent of such benefit, the exemption would be forfeited. Next. Then there are transactions with such persons. So if you have given any part or property to that person on you have let out, and while letting out you have not charged adequate security or interest or both, then to that extent the income will forfeit exemption. Any land, building, property made available to such persons without charging adequate rent or compensation, that also is one reason for forfeiting the exemption. Any salary, allowances, etc. paid to persons mentioned in 33, which is unreasonable, then the exemption would be forfeited. Here we have to particularly consider about the trust carrying out educational activities or hospitals. So in case of hospital charitable trusts, generally they are constituted by doctors. So those doctors are working in those very institutions and they get remuneration. So getting remuneration is not prohibited. You can get remuneration, you can obtain remuneration, but that remuneration has to be reasonable. If it exceeds the limit of reasonable remuneration, then the benefit will be forfeited to the extent it is unreasonable. This reasonable aspect we are familiar, because this terminology is already used in section 48(2) while we ascertain the income from business or profession. Next. If any asset is sold, if the services or institution are made available to the person in 13(3) without adequate consideration, if any asset of the institution is purchased from such persons for unreasonable amount, or if any asset of the institution is sold to such persons for inadequate consideration. So in these 3 circumstances as well, the benefit would be forfeited to the extent of unreasonable amount benefit being given to the interested persons. Next. Next. If any, so these were various instances in which it is likely that a person will be forfeiting the registration. Only you take earlier slide. In earlier slide there are 2 more reasons for forfeiture. Earlier slide. Anyway, if any income or property of the institution exceeding rupees 1,000 is derived during the previous year diverted in favor of such person, and if any funds of the institution continue to remain invested during the previous year in any concern in which these persons are interested. So these are 2 more reasons where the exemption is likely to be forfeited. Not likely to be, it will be forfeited. Next. Next. Now let us consider income of the charitable institution. So these are principal categories of income of a charitable institution. One is voluntary contribution. As you know, in case of the concept of income is with quid pro quo. So if you sell something, you will get the money. So that is against selling of goods. If you render services, you will get compensation. So whatever money you get is against rendering of services. If you are in employment, maybe you are employed, so you get salary. If you have a property, you give it on rent. If you have money, you give it on loan. You get rent, you get interest. So in each case, you do something and you get income. So that is called quid pro quo. But in case of voluntary contribution, somebody donates you the amount for the purpose of your objects, maybe public religious, maybe charitable. So from the normal concept of understanding of income, there is no quid pro quo. Therefore, it is not an income. But when it comes to income tax law, the Act defines what is income in an inclusive manner. And one clause, clause 2A of subclause 2A of clause 24 of section 2 tells us that if any voluntary contribution is received by a charitable or religious institution, that will be considered as income. So one cannot say that this is voluntary contribution, it cannot be considered as income. It is considered as income. Then there can be property income from the property held under the trust. It is possible that the property is wholly held for charitable purposes or partly held for charitable purposes. So earlier there were some trusts where the trust creator said that okay, from the income 40% will be spent for my family benefits and 60% will be spent for charitable causes. So this trust existed partly for charitable purposes. So only that income, to the extent it is for the purpose of charity, enjoyed exemption. Income which was not for charity did not enjoy exemption. But such trusts are not there after this particular act. So now only trusts which are only for charitable purposes, they exist. So entire income is income of the trust, which is subject to these provisions. And in case of earlier trusts which were already registered, so in their case, part of the income which exists for charity would be subject to these conditions. It is possible that trust is again having some objects of international benefit, maybe world peace or something like that, or carbon emission. So these are the objects, and where maybe worldwide you have to do activity. However, as far as ordinary charitable institution is concerned, the application has to be for charitable objects within India, not beyond India. But there are certain institutions, if their objects also inure benefit to any contingent beyond India, then this particular application would be subject to the terms and conditions laid down by the Central Board of Direct Taxes. So their income would be exempt if they follow the conditions laid down by CBDT. Then there are corpus donations, which we'll discuss. Capital gains separately. Trust also has a property that trust may sell the property, earn capital gain, or as a property of the business institution, maybe there is a business undertaking, and that business undertaking is being run, and entire income is used for charitable purposes. So that is also income of the trust. We will see rules about some of those incomes next. So voluntary contribution, we have already seen that the definition is there, which says voluntary contribution is income, and also subsection 1 of section 12 says that voluntary income will be considered as income, and for the purpose of 11, it shall be taken into account to calculate that 85% and 15%. Next. Let us see some examples relating to institution. So institute receives donation 3 lakh, this will be its income. Membership fees received is its income. Capital contribution received 10 lakh. Now capital, in case of income, capital receipt is not income. Therefore, capital contribution will not be considered as income. It will be corpus donation, and it has specified rules relating to that. So we will see those rules. Then contribution for building construction. Here again it is a capital receipt. So corpus donation, we'll see them separately. Then contribution for vaccination drive. This is again object of the trust. So this will be income. Interest received by fixed FD, rent. These are also incomes. Only we have to calculate income in the manner laid down, not in the manner laid down in the Act, but in a commercial sense. So when rent of 4 lakh rupees is received, this entire 4 lakh rupee will be considered as income. 30% deduction under section 27 will not be available for the purpose of these trusts. Not 27. 17 section, whatever deduction is available, that will not be given to these trusts. Then interest on RBI tax-free bonds and agricultural income, whether it is income. Now, if you look at the phraseologies in each particular these sections, section 2 defines total income. It says that total income is the income computed in the manner laid down in this Act. If you refer to section 10, section 10 tells that total income will not include the following incomes. But if you go to section 11, it says that the income received by a person from the property held under the charitable trust will be exempt subject to these provisions. So there is distinction between total income and income. So there is one school of thought, Allahabad High Court particularly, which says that income, whether it is taxable or tax-free under section 10, should not be considered, and it should be considered for the purpose of application. So if there is interest on RBI bonds 5 lakh rupees, agricultural income 3,60,000 rupees, that will also be subjected to the 85% and 15% formula. If you don't spend anything out of, say, agricultural income, then it also will be exposed to tax. But against this, there are certain other high courts like Madras High Court or Madhya Pradesh High Court. They have taken a view that this particular exemption would also be available to charitable institutions. And I also subscribe to the thought that these are available for charitable institutions for the reason that if supposing, firstly, as far as section 11 is concerned, although the section 11 uses the word income, section 11 comes under chapter, and that chapter heading is incomes which are not part of total income. So chapter 3 is not for the purpose of taxation, but for the purpose of giving exemption. So you cannot create charge under the chapter which exists for conferring benefits. That is number one. Secondly, assuming that that particular aspect is not followed, the 85% application, in that case, if it is to be taxed, it will be taxed for the purpose of taxation, total income will be ascertained. So while you ascertain total income, you have to follow the rules given in the Act, and there, for the purpose of computing total income, exemption under section 10 is available. Assuming that that is not available and you calculate income as say 5 lakh rupees from tax-free bonds, then for the purpose of charging tax, you have to refer to Finance Act. In case of Finance Act says in case of individual, HUF, AOP, BOI, etc., the tax will be in the following manner, and they say total income does not exceed 2,50,000 nil. Total income, if it exceeds 2,50,000, does not exceed 5 lakh, 5%. So whenever you refer to this Finance Act for the purpose of payment of taxes, it refers to total income. So for the purpose of total income, again you have to come back to Income Tax Act, and under Income Tax Act, section 10 says that on tax-free RBI bonds there is exemption. So I believe that exemption can be claimed. And in case of agricultural income, it is beyond doubt that it will not be taxed, for the simple reason that besides this all analogy, the Income Tax Act is creation of Constitution. The Constitution has divided sources of income between center and state. As far as center is concerned, the central government is entitled to tax income other than agricultural income. And if you look at state list, state governments are entitled to charge a tax on agricultural income. So central government is not competent to charge tax on agricultural income. Therefore, in any case, agricultural income cannot be subject to tax Whether you spend 85%, do not spend 85%, whatever way in manner you do with that agricultural income. Next. So these were some of the examples of income. So if we consider all these aspects, the donation received, membership fees, interest, rent, etc., what is the total income? So the amount of total income will be all income excluding 9 lakh rupees, which is corpus donation. And what any condition applicable? That yes, condition is applicable, and that is for the purpose of 1 to 4, you have to spend minimum 85%. If you cannot spend, maybe apply. And in case of number 5, corpus donation, you have to follow the regulations which are applicable to corpus donation, which we will discuss hereafter. Next. Corpus donation. Now, in case of corpus donation, up to earlier year, it stated that income in the form of voluntary contribution made with a specific direction that they shall form part of corpus of the trust of the institution will not be considered as income of a charitable institution. So that was a plain vanilla provision. So anybody says take 10 crore rupees as corpus donation, you accept 10 crore rupees. Whether you spend, you don't spend, you invest, doesn't matter. There is no tax on it. But from 1/4/2022, that is assessment year 22-23, one more condition has been enjoined upon this particular corpus donation. And that condition is, whenever any corpus donation is received, then it should be invested or deposited in one or more forms which are mentioned in section 11.5. So under section 11.5, the corpus donation should be invested. Then only it will be not subject to tax. Of course, if it is applied for the charitable purposes, then also it will not be liable for any tax. Next. Now let us assume that there is income of 7 lakh rupees, interest of 3 lakh rupees, and corpus donation of 3 lakh rupees is received. If charitable expenses are 13 lakhs, then here the income will be 7 lakh plus 3 lakh, 10 lakh is income. If you have spent even corpus donation for charitable purposes, doesn't matter. You have spent, as far as this 10 lakh is concerned, more than 85%, so exemption will continue. When you purchase ambulance, still the exemption will continue because there is no distinction between capital and revenue expenditure. In another case, supposing you have started construction of a hospital and 9 lakh rupees are spent on construction of hospital, hospital is not complete, still this 9 lakh rupees will be considered as application for charitable purposes, because it is not necessary that the asset must come into being. Even if for ambulance, supposing you have given advance of 8 lakh rupees, that 8 lakh rupees will be considered as application for charitable purposes. And it is not that you have not purchased the ambulance during the year, so it cannot be considered. That is not the case. Maybe in second year you will pay another 2 lakh rupees and accept the delivery. But this year if you have paid advance of 8 lakh rupees, that also will be considered as advance application for charitable objects. Investment rupees 2 lakh. Here corpus donation received is 3 lakh. And out of that you have invested only 2 lakh rupees. 1 lakh rupees not invested as per provisions of section 11.5. In this case, this particular amount of 2 lakh rupees would be exempt, but 1 lakh rupees which are not invested would be exposed to tax. They will not be considered as exempt as a corpus donation. Next. Then where this is now capital gain. So where capital gain arises to the charitable institutions, one has to consider its exemption. Supposing the asset is purchased for 4 lakh rupees, its index cost is say 7 lakh rupees and it is sold for 10 lakh rupees. In that case, if assets purchased for 4 lakh rupees is sold for 10 lakh rupees, then the capital gain will be calculated without considering indexation. In a commercial sense, you purchased for 4 lakhs, you sold for 10 lakhs, so your capital gain is 6 lakhs. Now, for the purpose of exemption of this capital gain of 6 lakh rupees, you have to consider application in a normal manner. If you spend it for the purpose of charitable objects, it's fine. But if you acquire another capital asset, and if the amount of another capital asset is 10 lakh rupees or more, then the entire capital gain would be exempt. Next, but if it is less than 10 lakh, So you have purchased another capital asset of rupees 7 lakh. Then how much capital gain would be exempt? It says that the capital amount of capital consideration that exceeds the capital gain, to that extent capital gain would be exempt. So you have acquired new asset of 7 lakh rupees. You purchased old asset for 4 lakh rupees. So your investment exceeds the purchase cost by 3 lakh rupees. So capital gain to the extent of 3 lakh rupees would be exempt, and balance 3 lakh rupee would be income of the charitable institution. Next. So this particular aspect has been just explained by way of this say that if 10 lakh 50,000 is sale price, 50,000 is commission paid. So ultimately 10 lakh rupees is the consideration. Cost of asset sold is 4 lakh rupees. Index cost is 6 lakh rupees. Forget about 6 lakhs. New asset purchased 11 lakh. Entirely it would be exempt. If new asset is 5 lakh, only 1 lakh rupee would be exempt. And if medical assistance is provided of 4 lakh, then to the extent of 4 lakh, exemption would be available under section 11(1), because this income is applied for charitable objects, and you have earned income of 4 lakh minus 10 lakh minus 4 lakh, 6 lakh rupees is the income. So out of 4 lakh, out of 6 lakh, 4 lakh rupees because of application for charitable purposes would not be liable to tax. Next. Then it is possible that supposing there is a running business of say selling stationery or selling grocery, and this business itself is given as a donation to the charitable organization. Then what about the tax provision? Because the condition says that whatever income you earn from this particular business would be used for the purpose of charity. So you made sales of 50 crore rupees. Your expenses are 45 crore rupees and the income is 5 crore rupees. So if you use entire 5 crore rupees for the purpose of charity, then those 5 crore rupees would be considered as exempt. Of course, since this is a business, it will also have to follow certain conditions. And in this case, the difference between the income as per profit and loss account and income as per computation, the difference will be considered for having been applied for other than charitable objects. So supposing your profit is 5 crore rupees, but because of certain disallowances, say 40A1A, 40A3, etc., your assessed income is 5,50,000. Then 50,000 will be considered 5 crore 50 lakhs. Then 50 lakhs will be considered as having spent for other than charitable purposes, and on that the tax will have to be paid. Next. Of course, this business has to conform to further conditions. Next, subject to subsection 1 or 2 or 3 or whatever, section 11 shall not apply in relation to any income of the trust or institution being profits and gains unless the business is incidental to the attainment of objects of the trust, or as the case may be, institution and separate books of account are maintained. So whatever business you are running, it must be incidental to carrying on of your objects. If it is not incidental, then it will suffer tax. If it is incidental, then it will get concessional tax treatment, as we discussed earlier. Of course, for charitable activities and for business, separate books of account must be maintained. Next. Now, let us assume the case of charitable institution where a benefit of treatment is provided to the person. Its medical treatment value is 1 lakh rupees and fees charged are 0, or fees charged are just 80,000 against 1 lakh rupee value. In case of college fees, maybe value of benefit is 1 lakh rupees and fees charged are nothing. So these are charitable institutions for, say, medical or for the purpose of educational purposes. So in these particulars, can we say that there is any income to the charitable institution? So for this, let us see the provisions of section 12, subsection 2. Next. So section 12.2 tells us that value of any services, being medical or educational services, made available by any trust running a hospital, medical institution or educational institution to any person referred to in section 33 shall be deemed to be income of such trust or institution during the previous year in which such services are so provided and shall be chargeable to income tax. So if supposing the medical treatment of is 1 lakh rupees and you have charged nothing, in that case, if that person is not person mentioned in section 33, maybe he is a poor person or he is class 4 employee, in that case, if you don't charge him or he is say ordinary person, not interested person, and you charge him concessionally say 80,000, in that case, nothing will be considered as income. But if that concessional treatment is given to the trustee or his relative, or if the person who has given substantial contribution to the trust, in their case, when 1 lakh rupee is the value, you charge nothing, 1 lakh rupee will be considered as income. And in case of 1 lakh rupee, you charge 80,000, 20,000 will be considered as income. Next. So this is the explanation what we said, that if you have charged compared to the value, nothing is income. If you do not charge or charge less, the benefit given to the person under section 13 will be the income. Next. Now, after having considered various categories of income, let us consider application, because first rule we have seen that whatever income you receive, maximum you can accumulate up to 15%, balance 85% has to be spent. But there are certain circumstances you are not able to meet this condition of 85%. Then what is to be done? So provision for application is there, accumulation is there. First we will see application. Next. So application has to be for the objects of the trust. Object should be charitable or public religious or both. Minimum amount of application should be 85%. Application must be in India. And if application is outside India, then it should be only if there is order of the board and conditions prescribed by the board. These are the rules. And whatever application is made out of income, if it qualifies that rule, that will be eligible for being considered as application. Otherwise, it will not be considered as application. Supposing there is a charitable institution, now a war is going on in Ukraine, and you find that okay, medical relief is required, and you just spend 1 crore rupees at Ukraine. So that will not be considered as application if there is no order of the board and you have not followed conditions of the board. But if there is order of the board, you have taken prior permission, then only it will be considered as application. Next. So besides this general rule, there are certain specific rules that those also will consider. But let us consider some examples. If loan is given for higher studies, if interest is charged, interest is not charged, would it be application? So the answer is yes. This money is applied for the object of the charitable trust. It is not necessary that you must give donation, you must give something free. Even if you are given loan to the needy students, maybe they will repay after they start earning. They may pay interest, they may not pay interest, but when you give the loan, that is considered as application of income. It may not hit your income and expenditure statement. It may come as a receivable in your balance sheet, but still it will be considered as application. Of course, when this loan is repaid by those persons, maybe with interest, maybe without interest, that receipt will be considered as income of the charitable institution. So even that receipt may not hit the income and expenditure account, yet whatever repayment of loan is there, that will be considered as income. So you have given to one student 10 lakh rupees in the year 2021. So that will be application for the year 2021, and in the year 2031, that person repays 3 lakh rupees. Then 3 lakh rupees will be considered as income in the year 2031. In both the cases, entry will not be made in income and expenditure statement. Then donation to other trust. If you are given donation to other trust, will it be application? The answer is yes. Is it necessary that other trust must spend those funds within the same year? The answer is no. It will be considered as income of that charitable institution, and then same rules of section 11, 12, 13 will apply to that trust. Whether it spends this year, next year, doesn't matter. Then purchase of ambulance, it is a capital expenditure. Will it be considered as application? The answer is yes. When you talk of application, you have to consider the object for which it is applied. You need not classify the expenditure between capital and revenue. It is all application for charity. Administrative expenses, repairs, rates, taxes of building, etc. All these are expenditure for the purpose of trust property. So after you incur those expenditure, then your trust property is able to give you income. So whatever expenses you incur on administrative reason for maintaining trust property, etc., that is also considered as expenditure to earn income, and whatever balance results is the income which is subject to the conditions of application. Next. Then rules for computing application. So this we have seen generally that okay, you spend for objects, that is application. But this particular application also has to conform to certain further rules. Now those rules are, now supposing you have received income of say 10 lakh rupees and you have also received corpus donation of 3 lakh rupees. So you have received 13 lakh rupees. You have spent 9 lakh rupees out of 13 lakh rupees. But out of those 9 lakh rupees, you have spent 3 lakh rupees from corpus donation received. So what it says that say in the year 21-22, out of 9 lakh rupees, you have spent 3 lakh rupees from corpus donation. So for this year, your total income is 10 lakh rupees because corpus is not considered as income. And you have spent 3 lakh rupees out of corpus. So from 9 lakh rupees, 3 lakh rupees would be excluded. So your application is 6 lakh rupees, that is falling short of 85%. So unless you take some steps for accumulation, you will forfeit the exemption. Of course, if you accumulate, which we will consider subsequently, then maybe your exemption would be live. So in sum and substance, when you spend out of funds which are received from corpus donation, that application or expenditure or outflow is not considered as application. Of course, there is another rule that in subsequent period, when you invest out of your ordinary income for the purpose of corpus donation, that will be considered as application. So in this given example, out of 10 lakh rupees, you have spent 9 lakh rupees, 3 lakh rupees come from corpus donation. So in the year 21-22, 3 lakh rupees will not be considered as application. But say in the year 22-23, out of your normal income, you have spent 2 lakh rupees for the purpose of making investment in government bonds against corpus donation received in 21-22. Then those 2 lakh rupees would be considered as application for 22-23. If in the year 26-27, you invest further 1 lakh rupees out of your ordinary income, then in that case, in the year 25-26, 1 lakh rupees would be considered as application against corpus donation received in the year 21-22. Next. There is another rule while computing business income, we make two disallowances. If there is failure on the part of complying with provisions of TDS, whether paid in India, beyond India. So if you do not follow the rules relating to TDS, you are not deducted, after having deducted, not paid, etc., then 30% of your expenditure is disallowed. If you incur any revenue expenditure, then in that case, that if it exceeds 10,000 rupees, then that entire revenue expenditure does not qualify for deduction. And again, there is another provision in section 43 that if you spend exceeding 10,000 rupees for purpose of acquisition of capital asset, that application is not qualifying for depreciation. So both these sections, section 40A1A and 40A33A, are made applicable for the purpose of application. So whenever any trust incurs in, supposing they are given funds for the purpose of say repairs to a temple, then in that case, if the TDS is not made, it will not qualify for deduction to the extent of 30%. If they have spent say those 30,000 rupees for repairs, etc., by cash, then entire 30,000 will not qualify for this application. Next. Then explanation 3A to section 11.1, we have seen in case of corpus donation how it is treated. Now this is donation received by temple, mosque, gurudwara, church, or any other place of notified under ATG 2B, which is generally a religious place, and you receive voluntary contribution for the purpose of renovation, repair of such temple, mosque, etc. Then how that donation is to be dealt with for the purpose of exemption. Next. It says that when you receive donation for the purpose of repair, renewals, etc., it will be, if it is applied such corpus only for the purpose for which the voluntary contribution was made, it does not apply for such corpus for making contribution or donation to the other person, and maintain such corpus separately identifiable and invest under section 11.5. So supposing you have received in a year donation of 80 lakh rupees for repairs of a temple, then in that case you have to use those 80 lakh rupees for repair of a particular temple for which it is given, because maybe you are a trust of that temple. Second condition is that you should not give anything out of that 80 lakh rupees to another temple for the purpose of its repair. That will not qualify as application. Thirdly, till the time you do not spend, supposing in year 1 you received 80 lakh rupees in the month of March, so you could not spend for repairs because tender was to be issued, contractor was to be appointed. Doesn't matter. You can maintain those 80 lakh rupees and you invest them under various mechanism which is specified under section 11 subsection 5. Then it will be considered as application. Of course, for the purpose of expenditure, you will have to withdraw from such investments. So if these four conditions are has to be satisfied in respect of specific donation which are received for repairs, renewals, etc. of religious places. Next. This we have discussed. If you have received any donation for forming corpus and subsequently you have invested, then it will be considered as investment for the purpose of that trust. Next. Then there is one explanation 4. Application for charitable or religious purposes from the corpus shall not be treated as application, provided that the amount not so treated as application shall be treated as application for charitable or religious purposes in the year in which the amount is invested or deposited back, which we discussed earlier. Next. This is one more provision. Supposing you want to spend for the purpose of say purchase of ambulance 30 lakh rupees. You had 20 lakh rupees, whatever be the income, you spend 20 lakh rupees out of income and 10 lakh rupees you have borrowed and purchased the ambulance. In that case, what will be the application in the year of purchase? In the year of purchase, application total application has been 30 lakh rupees. However, out of those 30 lakh rupees, 10 lakh rupees come from borrowing. So those 10 lakh rupees will not qualify as application, and application will be considered under section 11 only 20 lakh rupees. And similarly, in the year in which you repay the loan, in those years of repayment, it will be considered as application. So in year 2, year 3, year 4, supposing out of 10 lakh rupees, in 5 subsequent years you repay to 2 lakh rupees. So in those 5 subsequent years, each year 2 lakh rupees will be considered as application. Or supposing in 2 years you repay 5 lakh rupees, then 5 lakh rupees will be considered as application in those 2 years. Next. Then explanation 5 has been made. It says that for the purpose of section 11, it is hereby clarified that income calculation is required to be applied or accumulated during the previous year shall be made without set off or deduction or allowance of any excess application or any year preceding. So supposing in year 1 you had income of 50 lakh rupees, you spent 60 lakh rupees, and in year 2 you had income of 40 lakh rupees and you have incurred expenditure of 25 lakh rupees. So earlier, because of case law, the trust used to take a stand that in earlier year when my income was 50 lakh rupees, I have spent 60 lakh rupees. So 10 lakh rupees is overspent. So in subsequent year, my income is 40 lakh rupees. I have applied 25 lakh rupees. So that earlier year's 10 lakh rupees you consider for this year and consider my application as 35 lakh rupees and compare 85% for 15%, 85%. But now it has been withdrawn. It is expressly provided from this year that deficiency of earlier year shall not be considered as application for that subsequent year. So even if you have spent 60 lakh rupees and subsequent year out of 40 lakh rupees, if you have applied 25 lakh rupees, 25 lakh rupees will be considered as application and not 35 lakh rupees. So here the trust will have to consider seriously before overspending. Or if they are overspending, it would be prudent for them to borrow and make the overspending so that in that year it can be considered as it will not be considered as an application, and in the subsequent year when you repay the loan, in that year it will be considered as application. So indirectly that deficit would be qualifying for application. Next. As far as this application is concerned, because of case law, what used to happen, supposing there is a charitable trust for medical relief, they have purchased ambulance for 30 lakh in year 1. So in year 1 they will claim 30 lakh rupees as application, and then for all the years over a period they will claim depreciation on those 30 lakh rupees, and that too was allowed as a deduction, considering that income is to be calculated in a commercial manner. And it was argued that in a commercial manner depreciation is one of the recognized expenditure. It has been clarified that whenever any capital expenditure is incurred which results into asset, the trust is eligible to claim depreciation if the capital outlay is not considered as application. So in year 1 you purchase ambulance for 30 lakh rupees. You do not treat that 30 lakh rupees as application. So maybe you charge depreciation for year 1, year 2, year 3, year 4 till the time the WDV reduces to insignificant. So depreciation will be available if you are not claiming capital expenditure as application. But in year 1, 30 lakh rupee is considered as application. In that case, trust will not be eligible for any depreciation either in that year or in any subsequent year. So for one capital expenditure resulting into asset, you will get deduction as application only once, not twice. That is the simple principle. Next. Then from assessment year 22-23, this one very significant provision has come, which is parallel to section 43B. It says that for the purpose of this section, that is section 11, any sum payable by the trust or institution shall be considered as application of income for the previous year in which such sum is actually paid, irrespective of the year in which the liability is incurred. Take example of a charitable institution running educational institution, and their monthly remuneration bill is 50 lakh rupees. So remuneration for the month of April is for the month of March, say 22, is paid in the month of April 22. So this particular provision says that although you have incurred liability in the year 21-22, but it is paid actually in the year 22-23. So you will not get deduction in the year 21-22, but you will get deduction in the year 22-23. So in case of all expenses, actual payment has to be seen, and whether liability to incur payment is not to be seen. This is similar to section 43B with two important differences. Difference number one, 43B applies to only specified type of expenses like PA, PSI, gratuity, interest, etc. But in case of section 11 explanation, it applies to all category of expenses incurred by the charitable institution or application by charitable institution. That is difference number one. And difference number two, and more significantly, in case of section 43B, if you do not pay by 31st of March, but you pay by due date for filing a return of income, then also it is treated as application in the year in which the liability is incurred. This proviso is not applicable for charitable institutions. So salary bill 50 lakh rupees for the month of March 22, if you pay in April 22, then it is not allowed as deduction in 21-22, it is allowed as deduction in 22-23. Even if you are paid on or before the due date, it will not qualify as application. So since this is the first year, I think professionals will have to seriously look at this particular provision. Of course, because of this, if there is any shortfall, subsequently we will consider provisions relating to accumulation where it can be covered. Next. Next. So these were important rules as far as application is concerned. Now let us focus accumulation of income, because it is possible that you are not able to meet the bar of 85% in some years. So what is to be done? To pay tax? No. The law has considered such situations and given option of accumulative income for expenditure at a future date. And those are two provisions. Let us consider them. Next. See, there are two types of accumulations. One is under explanation 1 to section 11. That is one type of accumulation. Explanation 1, clause 1, subclause 2. And another accumulation is under subsection 2 of section 11. So we will consider both. First, we will consider section 11 explanation 1 accumulation. Now, this provision simply says that if during the previous year you are not able to make application of minimum 85% of your income because you have not received the income. Supposing you have purchased bonds. On those bonds, maybe you will receive interest after 5 years. So funds will not be available with you. So how you can spend? Or you have given premises on rent, but the tenant is not making payment of rent maybe for last 5-6 months. So how you will make application? So if in a particular year you are not able to apply minimum 85%, either because you have not received the income or for any other reason, that reason is not required to be specified. Maybe you are not able to reason because you did not plan or your planned expenditure did not come up, whatever. So in both these cases, you can accumulate the income under section 11 explanation 1. Next. What it says that in subclause 1, that is you have not received the income, then what is to be done? You can accumulate it and spend it in the year in which you receive the income or in a year subsequent to the year of receipt of income. So in 21-22, there is say interest of 10 lakh rupees and your total income is 15 lakh rupees. So interest of 10 lakh rupees you did not receive in 21-22, so you could not spend. So you can opt for accumulation. So this accumulation is permissible in the year of receipt or year thereafter. So you receive 10 lakh rupees in the year 23-24. So those 10 lakh rupees you can spend in the year 23-24 or you can spend in the year 24-25 or partly in year 23-24 and partly in the year 24-25. It is also possible that you receive only 5 lakh rupees in 23-24. So you spend say 5 lakh in 23-24 or in 23-25 or partly in both the years. And subsequently you receive another 5 lakh rupees after 26-27. Then in those 2 years you can spend those 5 lakh rupees. So that way year of receipt and year subsequent. That would be the period for accumulation. And secondly, you have received the money but you are not able to spend, then in that case in next succeeding financial year you have to spend that amount. So this is the accumulation under section 11.1. Next. For the purpose of this accumulation, it is necessary that you take your option and inform the assessing officer. This information has to go to the assessing officer before the due date for furnishing return of income, and this particular information should go to the assessing officer in form number 9A electronically. So 9A is prescribed for application for accumulation under explanation 1 to section 11. Next. Now, income so deemed to have been applied shall not be taken into account for this purpose, but supposing you should have spent in the years given year. So in case of receipt, you should have spent in the year of receipt or a subsequent year. In any other case, you should have spent it in a subsequent year, but you do not do so. In that case, in the year in which the breach gets confirmed, it will be considered as income. Next. Next. We will skip the example next for want of time. Next. Next. This we have discussed. Next. Next. So 11.2. Now 85% of the expenditure money you cannot spend, but you want to set it apart. Supposing you want to take one conference which requires substantial outlay, or you want to purchase a premises which requires substantial funds. So maybe you can accumulate the income for certain purposes as you define, and those can be applied within subsequent 5 years. You cannot accumulate beyond 5 years. Next. So you have to file with the assessing officer the purpose for which you are accumulating, the period for accumulation which cannot exceed 5 years, and the income so accumulated under this section or under explanation to 11.1 has to be invested in mode specified in section 11.5. Next. Next. So statement is required to be filed with assessing officer, and that statement is in form number 10. Again, it is required to be filed on or before the due date for filing return of income. Next. Next, keep the example. Next. So whatever you have accumulated under section 11.2, either you do not invest in a given mode, you do not apply it for the purpose for which it is accumulated, or you apply it in breach of these provisions. In all those cases, it becomes your income. Next. Next. Now here, as I stated, you have to furnish form number 9A or form number 10 on or before the due date, but a circular has been issued by the Income Tax Department, circular number 1 of 2020 on 3rd January 2020, where the powers have been given to the commissioner to condone the delay up to 365 days. So if you forgot to do it on at the time of furnishing return of income, you can subsequently furnish and seek condonation. Of course, for condonation, you will have to give appropriate reasons. Next. Next. So if you do not follow, then there is a breach. Next. Then we'll go to straight away investment. Next. Go to investment. These are all we have discussed already. Next. 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 So these are mode of investments which are prescribed. Next. So the forms in which the trust should make investment, they are listed out in section 11.5. So we have to carefully look at section 11.5. Only in those modes funds of the trust can be invested. Firstly, it is savings certificates under Government Savings Certificate Act or Small Savings Act, deposits in public post office saving bank, or deposit account with scheduled bank or a cooperative bank. So scheduled bank will include State Bank of India, its subsidiaries, or other banks which are acquired by nationalized under Acquisition and Transfer of Undertakings Act, or maybe those banks which are appearing scheduled to the RBI Act. So virtually all banks are covered. Next. So investment in Unit Trust of India, investment in any security for money created and issued by central government, state government, debentures issued by company or corporation where the interest and principal is guaranteed by a central or state government, or investment in deposit of a public sector company. Next. So deposits and bond issued by financial corporation engaged in industrial development in India, construction or purchase of residential houses in India, urban infrastructure, or investment in immovable property. So these are also some of the modes of investment. Next. Then deposits with Industrial Development Bank of India and any other form or mode. Those any other form or mode are given in Rule 17C, and principal ones are mentioned here. That is the mutual fund units which qualify for deduct exemption under section 1023D. Then public account authority for housing accommodation, depositories, recognized stock exchange equity, payment and settlement systems equity and bonds, incubator equity, National Skill Development Corporation equity, RBI Infrastructure Finance Company debt, sovereign gold bonds under specified conditions. So for this, specified conditions are available. So these are the investments in which the trust should invest. If any investment is made beyond these means, then in that case the exemption will be forfeited to the extent of investment. Next. So friends, to sum up, next, if you have to consider the provisions of exemption for charitable trust, section 11 talks about the application. For application, certain more rules are given, like you have to deduct tax at source, you cannot spend otherwise than by account, pay, check, banking channels, you cannot claim depreciation as well as both the deduction, either depreciation or so many rules are laid down in section 11. Section 12 tells us what is the income. Section 12A gives the guiding principles, the conditions which are applicable for this claiming exemption. Section 12AB is the procedure for registration which each trust has to follow, and section 13 lists out the conditions under which the exemption can be withdrawn. So these were in a nutshell the provisions relating to exemption and taxation of charitable institutions. Next, so here I conclude. I hope that I have covered all the provisions elaborately. However, if there are any issues, maybe if there are in chat box, maybe Chandrakant can read them. We will deal with them. Otherwise, thank you for the patient hearing. Please remove the PPT.
Yeah, thank you, sir, for your very well, given explanation on charitable institutions. I do understand because it was a very vast topic and we have to make little rush. But then, whatever the main provisions over there were properly explained by you, sir. Sir, there are around nearly 160 questions are there. I don't know how you want to take it, but
what I would suggest is maybe you can take important questions. For other questions, maybe through committee mechanism, we will respond.
Yes, sir. Yes, sir. So what I will do is I'll read some few questions for you.
Yes.
There's a question from Ravi Prakash Shah. He says that if an NGO is carrying fixed assets in its book at WDV and he is not possible for him to obtain the gross value, and how should he represent it in the ITR form? Because in the presentation it says that the cost has to be given, and how he has to align with the balance sheet with ITR as far as no bifurcation of investments, whether it is made in corpus or specific fund or general fund, has it been shown in the balance sheet. So what we should do?
As far as taking second question first, one will have to ask the trustees, see the resolution, which it is made out of which funds. Otherwise, one can also draw funds flow statement and consider, because as far as corpus donations are concerned, it is mandatory to invest. As far other donations are concerned, it is optional. So if trustees have not made any resolution, just they have invested, maybe they can have a resolution from the trustees what is to be considered under which fund, and then accordingly that will be the guiding factor for the purpose of answering. As far as this asset question is concerned, this question also comes up in case of companies where maybe earlier record was not there, etc. And there the auditing standard has explained, maybe you consider earlier their valuation in the year of receipt, etc. And on some basis you appropriate, and accordingly you may consider with proper disclosure.
Yeah, thank you, sir. Correct. There is little confusion here that Mr. Chakrapani, CA Chakrapani from Hyderabad says whether the 10BD is to be filed by everyone or those who are having only ATG.
As far as this section provision of section this 10BD is concerned, it is applicable under section 80G5. So it is applicable only for the institutions whose donation enjoys exemption under section ATG. There may be certain religious trusts for which this ATG benefit may not be available with donations. So they are not required to furnish. Of course, it's not that in all religious trusts this benefit is not available. Where there are important religious trusts, they have applied and they are also eligible, their donations are eligible for ATG. So those trusts will have to be filed. And then this particular 10BD requirement comes under section 35. So those institutions which are eligible to pass on benefit of this 100% deduction under section 35, they are also required to file this form 10BD. Others are not required to file.
Yes. Sir, there is one question again, very important question from all of us. Nilesh Lokhande from Pune, he says, sir, he has failed to file form 10A for the trust for renewal of 12A and for ATG also. So he has, by mistake, he has not filed it. So what should he do now?
As far as this query is concerned, immediately they should take steps and file form A, because there is no provision for condonation of delay. So for the year for which registration is not available, I am afraid that this particular benefit of exemption would not be available for the charitable trust. So maybe at least now if they file, maybe from this year onwards they would be eligible for donation. Of course, there is also 1 month time lag. So from the month of application, maybe next month they would be eligible to do that. And
Yeah, but
subsequently, no, let me complete. And
yes,
as far as such delays are concerned, when there is no general provision, maybe the Central Board of Direct Taxes under section 119 can provide relief for such administrative deficiencies or delays. They may try with the CBDT and make application for condonation of delay.
Okay. Sir, there is a question from Hemali Gandhi. She says, insertion of explanation 3 to 23rd proviso to section 10 into bracket 23C for determining the amount of income applied to charitable purpose, only such income as is actually applied would be considered. The application of income would not consider the amount incurred. This is like promoting to shift to cash system of accounting. Also, this is effective from assessment year 22-23. Is there any clarification or circular issued subsequent to this amendment?
Generally, whatever is the intention is given in memorandum to the finance bill and notes on clauses. So there you will find that they want to go to cash system as far as application is concerned. So that is the explanation. And on Finance Act also they come out with a circular. So there they will explain. They have explained whatever is the. But as far as this seminar is concerned, we are interpreting the law even as it is. So today the law for 1023C or 11 says that we will consider application only if the amount is actually laid out or paid. So it is like going to cash basis when it comes to application.
Correct. There is a question been asked by Krishna Swami from Hyderabad. He says that if no donations is received during the year, still we have to file 10BD?
In case of, if you refer to section 80G5, it says that this particular statement is in respect of donations received. So if you are not received, then there is no obligation for filing this particular 10BD. It is like TDS. If you are not deducted tax during any particular quarter, then you don't file the TDS statement. So likewise, if you have not received the donation, no need to furnish statement. Because this statement goes in the mechanism of faceless assessment that in case of donor, when they claim ATG or 35, it is automatically cross verified. So
Yes.
this enables seamless assessment. You are again not required to inquire.
Correct. Sir, there is one more question from Sanjeev Agarwal from Itawa. He says that in case of application by a running educational institution for 12A registration was moved in financial year 2018-19, the same is pending before CIT exemption after set aside by ITAT since July 2019. Now, nothing was happened with this application. So he has moved a fresh application under the new provisions in the financial year 21-22. Provisional registration was granted for 3 years. And sir, what will happen with the earlier pending application in view of the provisions of the new section 12AB1C?
So as far as they have received provisional application, so they have applied as if they are considered as a new trust, the residual clause. So maybe 6 months after they start incurring expenditure, they must have running institutions. So from 1st April, they have started incurring expenditure. So before 30th of September, they should have applied for permanent registration. And as far as their earlier application is concerned, the matter is sub judice, as I believe that it is before the tribunal. So tribunal will consider whether they are eligible, not eligible. So if tribunal considers that they are eligible, they will get earlier years exemption as well. In that case, they can move to the authority that since we are registered on 31st March 2021, maybe you should give us permanent registration rather than provisional one. Of course, if this particular registration is rejected, there can be two reasons. One is because there was breach of certain provisions, maybe 11(5) not followed, or giving some benefit to the trustees is one reason, and objects are not in conformity with the section 11(12) or section relating to definition of charitable purpose. If it is rejected because the object was not in conformity with the definition of charitable purpose, then I'm afraid even this provisional registration also will be withdrawn, because that is the reason for rejection of registration. So they should look into the grounds why their registration is rejected by the assessing officer, and accordingly they should take the corrective steps.
There is one more question. We'll take another 1 or 2 questions, sir.
Okay.
Because many questions are on section 10BD, again on the registrations. I think that we will answer.
So 10BD is fine. I believe that the due date will be extended. So maybe we'll come out with a supplementary.
There are a lot of questions whether international funds we have been received. Well, very common questions have been asked when you have given your deliberations. I think we can answer it through mails to them. There is one question here. By Mr. P. Satyanarayana Murthy from Hyderabad. A charitable institution is receiving donation in kind of groceries to do annadan. Does it has to account for the receipt and also for utilization as expenditure?
See, as an accountant, the answer is yes. It is not only that you have to consider cash, but you have to consider whatever properties are received by the charitable institution is a donation, and accordingly you should account for. Now, generally, two things are followed. Either they are accounted for at a token price or at an actual price. Whatever way you follow, it's okay, because you are giving that particular grocery as a donation to needy person. So it is entirely application. If you consider Form 10BD, Form 10BD also requires to give information about donations in kind. So there, I believe that in case of, they have also asked the amount. So amount would be a fair market value of those donations, as I see. But there is no clarity. We have asked the question, but reasonable interpretation would be, in case of kind donations received in kind, you should state fair market value. Now the issue is whether they qualify for deduction under Section 80G. The answer is no, because donations in kind do not qualify for such deduction. Then the question is, then why to give the information? So there may be the answer that the income tax department would like to know that, okay, who are the persons who have given this in kind, and from what is the source from which they have given this donation. Because somebody has given, say, grocery of 10 lakh rupees. The department would certainly like to know that whether this 10 lakh rupees have suffered tax, not suffered tax. So maybe this information would be useful for their inquiry. So I believe that yes, this information needs to be given. Accounting, maybe whatever way they consider appropriate, they can make it. If they do not account for in the books of account, maybe at least in their annual statements, they should give quantitative details of the receipt and of distribution, so that the readers will know that, okay, besides whatever is the balance sheet of income and expenditure size, this particular activity was also carried on by the charitable institution. So it is more enlightening the stakeholders.
Sir, last 2 questions we will take it. Vikas Praveen Chandra Pancholi from Surat says, some educational institutions are receiving grants from Samaj Kalyan department or from the
Government
government.
departments. Yes.
Yes, and these schools are also having approval under 80G. So whether
Yes.
such grants are required to be disclosed in Form 10BD.
So there are two views. In one quarter, they say that okay, it is received as a grant. So you are a conduit for the purpose of collecting money, and generally these college grants are for the purpose of paying remuneration to the teachers. But then again, one school of thought is these teachers are employees of the institution, and therefore whatever you receive is say like a donation from the government, which is to be used for a specified purpose. We appreciate that government is not eligible for the purpose of donation under Section 80G. So in that sense, if it is not reported, it doesn't matter. But if you report, it would be better, because subsequently, if some assessing officer takes a view that you have received total, say your income side is 1 crore rupees and you have reported under Section 10BD only 10 lakh rupees. So what about 90 lakh rupees? And then associated inquiry and other things may follow. Instead of that, if you give say particulars of entire 1 crore rupees or 10 crore rupees, whatever is there, maybe subsequent processes would be easier. So to my mind, they say that okay, you give a list of donations. The form also requires donations given in kind to be specified, although it is ineligible for deduction under Section 80. Similarly, I believe that grants received from government need to be disclosed. But if they are not disclosed, then this is the line of argument to defend the case.
Okay, so the last question for the evening, which is a confusion one. Debasis Chakraborty from South Delhi, he asked questions that there is an educational institution is having exemption under Section 10 into bracket 23C 3AB, and it is also approved under 80G also. So whether such a institution has to apply for registration, and I think that whether he is talking about the 12AB or what. If yes, then what is the process?
Both registrations for eligibility to grant 80G and for 1023C they have to apply. In case of 1023C, at times there are certain institutions which are not required to apply. If they confirm those provisions, then per se for 1023C application is not required. But for 80G entitlement, application is necessary for all trusts, whether 1023C or 11.
Correct. There are few other questions, but which are very common
We
as
will
per
take
this
up,
10BD. So we will,
related
sir.
to 10BD, we will take up in supplementary to our
Most of
publication.
the questions are also on
I
10BD
believe
and
that the
registration.
due date may be extended.
And other questions regarding the registrations only, what to do, when to do, what should one do in this particular thing, which are very common, I think. And sir, as while giving the...
Or maybe at committee we can think of a follow-on presentation webcast to deal with all those queries.
There is one more suggestion given by, but that restricts to Maharashtra only. He says that whether we can arrange a lecture on Bombay Public Trust Act. So that was Mr. Ralekar from Chiploon. So that is only restricted to Maharashtra actually. So you can.
No, each state will have state act. So all states.
Yes. So it becomes a little difficult.
Yeah. Okay.
So anyway, let me first thank our own CCM who has taken a lot of efforts to to talk to us and to explain us in detail how the functioning of a charitable institutions, whether a religious institutions have to do as far as the compliance of the law is concerned. So on behalf of all of us who have been here, there are around 2,700 plus who have joined your webinar today. From all of us from this side, we would like to thank you, sir, for putting all your efforts and contributing your valuable time and sharing your knowledge with us. At the outset, I would also like to thank CA Shrutika Oberoi and all the other technical team who has ensured that this webcast is coming to us in uninterrupted manner, and at the same time all the arrangements that they have made before the webinar and after this webcast, during the webcast. So I thank all the indirect tax direct tax committee team and all the members for organizing such a wonderful webcast. And in the end, I also thank the committee, Direct Tax Committee, for organizing such a wonderful webinar. And a special thanks to our own CA Chandrasekhar Chitre sir, who always takes a lot of efforts to ensure that our members are well educated and well understood as far when it comes to the profession and the members in practice are concerned. So with this, I would like to thank all of you. Thank you, sir. Thank you for everything. Let us end our webcast here. Thank you. Thank you very much.
Well, thank you and good night.
Good night.